Thanks again for watching. Today I want to talk about deductions of vehicle expenses. This includes mileage, actual expenses, Section 179, who can write off the expense, who can't write off the expense, what kind of record should you keep, what would be a red flag for audit. It's just some of the things that I wanted to cover in this video. Again, if you guys find these videos helpful and useful, please feel free to like, subscribe. If there's something that you'd like to hear about or a little more information on any of the videos that I post or something that I haven't posted, please feel free to leave it down in the comment sections below and I'll be sure to take a look at it. So let's just first talk about vehicle expense. So a lot of people drive for their job, whether that be you're self-employed, own a company, work for a company. There's a lot of the things that are considered when it comes to driving for your particular job. So let's talk about who can take those deductions on your tax return. Individuals, the easier part is probably individuals who cannot take it. So employees, so if you receive a W-2, typical weekly paycheck, you are not allowed to take a deduction for your vehicle mileage. Your employer should be reimbursing you for these miles, within your paycheck. And again, whatever that specific policy is within your company, whether that be an actual mileage reimbursement that you submit for reimbursement on a specific basis, or whether that be a flat additional stipend that you receive. So, i.e., some salesmen receive maybe a $300-400 flat amount that they receive for mileage reimbursements. But again, if you are a W-2 employee, this amount is not able to be deducted. Now, if you receive 1099s, for one particular cost, you are, for all intents and purposes, considered self-employed. And you will be able to deduct your mileage, your vehicle costs, or the price of a car. Again, also, if you work for a company or if you own a company and you drive a vehicle for that company, your company can take a deduction for that particular vehicle if it is a business-owned asset. So let's kind of just talk about a couple of things. So let's talk about self-employed, because I think this is probably one of the larger categories. So you own a business, maybe you do sales, maybe you do some insurance adjustments, or roofing, a contractor or whatnot. So you own the business, people pay you, you don't receive a paycheck. There's two different methods that you can utilize. You can utilize what's known as actual expenses, or you can utilize what is known as the standard mileage deduction. So standard mileage deduction is just that. It's your actual mileage that you drove for business, multiplied by the standard posted rates. So for tax year 2024, that posted rate is 67 cents per mile. For tax year 2025, that posted rate is 70 cents per mile. And again, that rate varies on an annual basis, and the IRS typically posts those rates, shortly before the start of the tax year, or towards the end of the tax year. There has been some instances where we've had some high inflation amounts, and they've gone up or they've changed midway through the year. So the last time that we've seen that would have been in July of 2022. That actually went up just due to the higher prices of gas. That was determined that there was needed a requirement to be an additional expense. Now, records required for that is really, it's just maintaining mileage logs. How much do you drive? Where did you drive on a particular day? It doesn't have to be in super details, usually like dates, name of customer that you went to see, or a specific business purpose that you did, and then the total number of miles. I always like to say that you always have to deduct your commuting miles. So commuting miles are not considered actual business miles. So I think that's always a misconception, is that you drove from your home to an office, so I can take those miles as a deduction. Well, that's not the case, because those are commuting miles and those are considered personal expenses. They're not considered a business expense. So pretty much, to be conservative, I always suggest that you take off the same amount of miles. So whatever your principal office location is, if that is your home, if you work out of your home and your primary location is your home, then by all means, you can take your mileage from your home. So what I would do is I was going to, say Home Depot, was my customer and I was going there to visit them. I'd go from my home to Home Depot, and then it should be readily available, meaning that you should be able to just go online, Google Maps, or Apple Maps, type in your home address, type into the location where you're going, and you should be able to get about that same total miles. Now, again, you can round up, you can round down, but if it's a percentage of a mile, so you want to round it to the closest mile. And then again, just have a log of that. There are certain apps that also track that. So again, you can download and use that app, or you can just use, on pen and paper and have a specific log. So that way, in the event the IRS were ever to come in, you can say, hey, here's all my miles substantiation. Here's where I deducted any personal mileage that I took off. And you kind of go from there. So now again, where this gets a little bit tricky is if you're going from one job to the next job to the next job. So I still usually suggest to deduct that normal commute. So if you have a normal commute, I would typically suggest deducting that normal commute or doing it from your home base. So meaning, let's say, I don't know, like you had to drive across town, had to drive a couple towns over, and then you basically had to drive back through where your office location is and then to the next spot. So kind of what I would do is, I would do a round trip back and forth from wherever you're going to a particular client, and then you can do another round trip from back and forth to where the next client is. It is possible that you can just do from one client to the next client, and you can kind of substantiate it that way. But again, what I would suggest doing is just deducting. So if you have an office location, deduct that standard miles. So if that standard miles is 5 miles, just deduct that off the top. So no matter where you go, deduct your standard miles deduction right off the top for wherever your office location is. So let's kind of skip ahead now to the second option, which again, these are actual vehicle expenses. So actual vehicle expenses would be your gas, your tolls, your repairs, license, registrations, any sort of thing that's associated with the vehicle. You'd actually have to keep receipts and maintain receipts for those expenses, or, if you're a particular business, whatever, put it on a credit card and whatnot for that particular business. So actual expenses. And then what you would end up doing is if you finance the car's interest would get written off, and then the car would get depreciated over 5 years. Now, depending upon what the type of car is, or vehicle is, I should say, if it is a heavyweight vehicle that's over 6,000 pounds and meets other certain specifications, so like, an example would be obviously like, you're driving around in a box truck. That obviously meets that. You're able to take what's known as an accelerated depreciation method. Another key important item is that you need to be able to utilize that vehicle for greater than 50% in order to get a Section 179 deduction. And essentially all that's happening here is that you're accelerating the depreciation. So instead of taking the depreciation amount equally over several years, over 5 years, which is the typical life of a vehicle, you will take it over at an accelerated rate. So basically you'd get a larger deduction this year, and then next year you'd get a smaller deduction. So again, just something to keep in mind and something to consider. It is definitely something out there that you can utilize and you can do. I know that a lot of times people will say, hey, I need it for tax deduction. My accountant, especially on social media, my accountant said I needed a tax deduction, so I need to go buy a vehicle, or I need to go buy 2 vehicles. Well, the larger misconception of that is, listen, if you don't need a vehicle, at the end of the day, taking that tax deduction isn't even worth your while, because you're out now $60,000, $70,000, $80,000 on the price of vehicle, and you're only saving your effective tax rate plus self-employment tax if you're self-employed. So you're still paying $70,000 in order to get your, say, $100,000 in order to get, say, a $2,000 tax break, or a $20,000 tax break. So if you didn't need the vehicle, it doesn't really make sense to go out and purchase it. The other misconception is that you can just go out and buy a vehicle that's over 6,000 pounds. Let's just say an SUV. And let's say you go out and you buy an SUV that's over 6,000 pounds. So say you bought like a Chevy Suburban. I think those are over 6,000 pounds, or another, some similar luxury SUV that's over that weight limit. You're only able to take $30,500 max deduction for tax year 2024. Anything over that would get depreciated and up into future years. Now, again, that caveat on that is that vehicle needs to be used for at least 50% business use, and you may need to add back some portion for personal use. So, meaning by that is you could take 50% of you could take the $30,500, and then that has to get multiplied by the percentage of business use. So if it's not 100% business use vehicle, then you would need to go out and multiply it by, say, 75%, 80%, whatever that is, and then that's the total amount that you can get. So you're not actually getting that full deduction in the first year. There had been years prior to that you have been able to get that full deduction, in the first year, but again, it's just a deduction multiplied by your effective rate. So if you don't actually need the vehicle, then you're not actually really getting a benefit from that. But if you're planning on purchasing a vehicle maybe in the next tax year and you had a really good year, then you might want to just accelerate that a little bit. But again, just kind of keep in mind that you won't get that deduction again in future years. And then again, now keeping records. So obviously, a box truck or, a vehicle that has greater than 9 seats in it, it's pretty easy to substantiate. You're not going to drive that around on a normal basis as your personal vehicle. But you're talking about getting like a Mercedes-Benz, like G-Wagon, you can kind of tell that odds are that's probably a personal vehicle, not really a business vehicle. So again, kind of keep those things in mind where you're going to have to substantiate that this is actually a business vehicle. You are actually using it, for business expenses and for business travel. The IRS does have a level of reasonableness, whereas they want, things to be reasonable. Like, is it reasonable for you to go to a sales call in a, Mercedes-Benz G-Wagon? Or if you're a contractor for that matter, it's reasonable for you to go to a call for sales or go to a job site in a pickup truck. So it fits within that, realm of type of vehicles that you have. So again, you just kind of want to substantiate it, and then you want to be able to add back for any personal use that you have. Because again, you don't want to if you take a vehicle home, that is a question on all the returns. Is this vehicle subject to personal use? Does this vehicle get taken home? So again, if that's something on there that it is taken home, you do use it for personal use, you do want to make sure that a portion of that vehicle is added back. Now again, if you take actual expenses, if you lease a vehicle, you can just take the lease costs. And then there is no real acceleration for depreciation. You would just end up taking your monthly lease costs multiplied by the business use percentage. So again, if it's 100%, you'd be able to take 100%. If it's not 100%, then you can't take 100% of that lease cost. You'd have to allocate it based on the percentage of business use. So again, kind of just keep that in mind. And, I always like to tell people all the time where it's like, oh, well, I want to go out and buy a new truck. I want a new truck. And it's like, okay, but what, and I ask them, well, what are you using it for? Are you actually going to use it for your business where you're going to utilize it for greater than 50%? So let's kind of drill down a little bit more on that greater than 50%. So let's just say you drive your car for 12,000. It's not based on hours. It's going to be based on miles. You drive that car for 12,000 miles a year. And of those 12,000 miles a year, granted, it may sit at your office. It may sit, wherever it is for, say greater than 50% of the time than what it sits in your driveway at home. But of those 12,000 miles, you only drove it 2,000 miles for business. That's not enough miles to be able to justify saying, hey, this vehicle is business use. So my recommendation typically is, especially freelance or, something where it comes to a personal vehicle, is to just take the standard mileage rate. It's a lot easier. Your records are a lot easier. Will you end up saving more money? Probably, it's less, but again, I mean, you don't have as much of as high of a burden to prove that this vehicle is used for business expense. So, that's why I always suggest take the easiest way, take the path of least resistance. If you are somebody that, drives a lot of miles and, you're frequently swapping out vehicles and, say you're a contractor, I mean, that's pretty reasonable that you need a truck. You need a truck to go to the job sites and whatnot. So that one you might want to maintain a little bit more records and say, well, I'm going to take actual expenses because it makes more sense. But I mean, if you're something like a CPA, it doesn't really necessarily make sense for me to say, you know what, I'm going to go on ahead and put my vehicle on the books of the company. It's easier just to say, I'm going to take the standard mileage rate deduction. Or vice versa. Say I'm the owner of an S corporation and, it's a professional organization. Maybe from time to time I go out and I sell things or whatnot, or I'm a attorney or just like a professional service. The better way to do it for a deduction on the company is to pay whomever it is, whether it be your top employees, instead of providing the actual vehicle for them, pay for the car for them through wages. So they put the car in their name and you say, okay, we're going to pay for it. Let us know what the payment is. You can put it in monthly, you can put it in a lump sum, and you add it into payroll. So it ends up being a fringe benefit. It gets taxed fully. It's a full deduction to the company, and then you don't have to worry about keeping the records of anything. And the employee's happy because they ended up getting an additional money in their pay. Or you can round it up and just give them a flat amount. Say, we're going to give you $1,000 a month towards a car. So you get gross $1,000 a month. Granted, they have to pay tax, and granted, it gets withholdings, and it could push them into a higher rate. But again, you give them an extra $12,000 a year. They purchase whatever vehicle they want. They handle the maintenance, repairs, etc. on it. and then they can kind of figure it out from there. And that to me is, especially for a company that's got multiple vehicles that maybe fall into that situation, is definitely is a lot easier to track it that way, and then you don't really have to substantiate any expenses. It's just easier for the company, easier for record keeping, easier for everyone all around, because now if you start having personal vehicles, whereas the company owns them, the company's going out and buying them, you got to repair them, you got to register them, you have to make sure that there's gas in them, you got to make sure that you have insurance coverage on it. And then at the end of the year, you got to go reach out to whomever it is. If you got multiple employees, you got to say, okay, well, please give me your mileage. How many miles did you put on the car? Of those miles, how many were personal use? Then you got to go and take those personal use miles and add them back into their wages if you pay them wages. Or similar, if you're the owner of the company, you don't get wages. So in the case of a partnership or a Schedule C, you have to add that income back into your return as basically as a fringe benefit for personal use of your vehicle. So again, I like to keep everything simple. Keep it simple. If you're getting a huge deduction and it's something that's worthwhile and actually makes sense for you to maintain those records, by all means then do that. But I'm a huge fan of opportunity costs, which means what are my savings? So what is my tax savings by actually taking these actual costs of the vehicle versus either taking a standard mileage rate or adding it back into employees' paycheck? What am I saving for costs? Is the tax savings really that great where I'm going to save a ton of money? Or do I not want the headache and I got to pay somebody else to really maintain these records, track the person down, and it ends up being more of a headache in order to maintain and substantiate the expense versus just including it in their pay? That's kind of the way that I would typically go to exercise. A lot of companies aren't really providing, company vehicles anymore, of course, unless it's like a delivery type service or something like that where, you actually need a bigger vehicle, or a contractor where you actually need, a large vehicle in order to, do the work that you have to do. For the most part, people will either, pay you a flat rate, include back in your pay, or do a reimbursement for driving your personal vehicle. But again, like I said, hopefully this helps, and hopefully you guys found this information useful. Again, like, subscribe. If you have any questions, comments, please feel free to leave them down below. And again, just kind of keep in mind, a tax deduction, a tax write-off, it really doesn't mean anything unless you're actually going to normally purchase that item. If it's something you wouldn't normally purchase, if you just bought a new car last year and you wouldn't ordinarily buy a new car this year, don't go out and do it, because it's not going to make sense for you. So, and you won't end up saving any money. So again, hopefully this video was helpful, and thanks everybody.